How well do you think central banks are doing for the past decade? For me, not so well. Central banks serve the purpose of steering their national economies. But what if I told you that for the past 10 years, they are actually leading them to the cliff? Flooding the market with excess liquidity, they led their economies to overwhelming inflation. But who is it to blame? Was quantitative easing a wrong decision, or it was simply poorly implemented? Was the unconventional monetary policy taking very long? And what will be the effect of lowering again the interest rates? Let's see what happened since 2015, what went wrong, and what should really happen. Imagine a person. Let's name her Christy. Christy wants to buy a new home, but she lacks some $100,000. Although she has a great, high-paying job in the tech industry and she's about to become a supervisor in her department. So she goes to the bank and asks for a loan. The bank evaluates her profile, decides about her substantial credit worthiness, and gives her the $100,000 with 6.5% annual interest for 30 years. This means that Christy will pay from now on $620 per month, and this is great news for her and her husband, because they were actually paying $850 per month for renting a small apartment. Now imagine that Christy goes to the bank and they agree to give her the same loan but with 10.5% annual interest. Now, the monthly installment will be $880, and Christy rejects the offer and stays with her husband at the small apartment. Christy's example is a common example that I teach to my students regarding monetary policy decisions. In our case, it is a monetary policy contraction. As the central bank's interest rates increase, so all the other interest rates increase. As a result, less loans are given and less money runs into the economy. Exactly the opposite happens with expansionary monetary policy, where central banks decrease the interest rates and more money flows into the economy. Now imagine that Christy runs a company. She wants to expand the production line with one more plant, but it costs some $1 million, let's say 10 mil. She goes to the bank and asks for a loan. The bank believes in the success of her project and offers a 10-year loan with 6.5% annual interest, leading to a yearly installment of about $1.4 million. Now, if the central bank drops the interest rates, the retail bank will follow. Now let's say that the bank offers a rate of 4%. This means that for the same plant, the same production, and the same prices of the company's products, Christie's company will pay $1.2 million annually. Assuming that in both cases the plant makes a profit before interest, tax, depreciation and amortization and before paying any principal of the loan of $2 million per year, this leads to a net profit of $600K in the first case and $800K in the second one. But what happens with the excess profitability of $200K? Well, this can lead to further expansion plans or a greater dividend for the company's shareholders. In the second case, an expansionary monetary policy was implemented. Now, in terms of the QE, imagine that the bank offers the same interest rate of 4%, but this time the central bank's interest rate is almost 0%, meaning that the retail bank can take a loan from the central bank without any interest. Also, during the QE, banks were able to sell any junk or risky asset to the central bank, and again, full their reserves. But with greater reserves and risky activities backed by the central banks, the banks are now able to issue loans with less strict credit profile requirements. Immediately, the economy is flooded with cash and turns hotter and hotter year by year, leading to greater profitability, more expansionary plans from the side of businesses, happier investors, and even happier bankers. Since August 2007, the Fed started to lower its interest rates, and the first round of QE was implemented in November 2008. After the third round of QE ended in October 2014, the Fed did not engage in large-scale asset purchases until the COVID-19 pandemic, although the interest rates remained at very low levels, meaning that the huge expansionary policy continued. The problem began when the economic recovery was in sight, yet the Fed continued with low interest rates and supportive measures. By 2015, signs of recovery were evident, but the Fed hesitated to tighten the monetary policy. This delay allowed the economy to become overly dependent on cheap money, setting the stage for future inflationary pressures and asset bubbles. The Fed should have started increasing rates gradually to prevent overheating and to create a buffer for future downturns. Keeping interest rates low for an extended period led to several negative consequences that have far-reaching impacts on the economy and society as a whole. The continuous injection of liquidity into the market led to higher inflation rates. As the Fed pumped more money into the economy, the supply of money increased significantly. This increased money supply led to more spending and higher demand for goods and services. However, the production of goods and services couldn't keep up with this heightened demand, leading to higher prices. The cost of living rose, eroding the purchasing power of consumers. Everyday essentials, like groceries, gas, and housing, became more and more expensive, hitting lower and middle-income families the hardest. It also led to probable asset bubbles. Low borrowing costs fueled speculative investments in various asset classes, including real estate, stocks, and bonds. Investors, enticed by cheap credit, poured money into these markets, driving up prices beyond their fundamental values. In the housing market, for example, low mortgage rates encouraged more people to buy homes, pushing property prices to record highs. Similarly, in the stock market, easy access to cheap capital led to inflated stock prices. These bubbles are inherently unstable. When they burst, and they will burst, they can lead to significant financial losses, economic instability, and a potential recession. Also, the problem with income inequality further expanded. Asset price inflation disproportionately benefited the wealthy, who are more likely to own significant assets such as stocks, bonds, and real estate. As these asset prices soared, the wealth of the affluent increased substantially, while those without such investments saw little benefit. This widening wealth gap has led to increased income inequality, where the rich get richer and the poor struggle to keep up. The economic divide contributes to social and political tensions, as disparities in wealth and opportunities become more pronounced. Lowering interest rates again in the current economic climate might not yield the desired effects for several reasons. After years of maintaining low interest rates, the marginal benefit of further reduction is minimal. Borrowers, both consumers and businesses, have already taken advantage of cheap money, refinancing existing debt, and securing low-interest loans. The pool of potential borrowers who haven't already capitalized on these rates is shrinking. Moreover, those who are creditworthy have likely already borrowed, leaving a higher proportion of riskier borrowers who may not qualify for new loans even at lower rates. Therefore, further rate cuts are unlikely to stimulate significant new borrowing or investment, as the demand for additional credit is already saturated. It will only lead to greed and pumping greater bubbles. Also, rate cuts can signal a lack of confidence in the economy's strength, potentially undermining business and consumer confidence. The same occurs when central banks tend to increase the volatility of their interest rates, signaling potential loss of credibility. When the Fed continuously changes rates, it can be perceived as a sign that the central bank is worried about the economy's ability to grow on its own. This perception can lead businesses to delay investments and hiring, anticipating that economic conditions might worsen. Similarly, consumers might hold back on spending, fearing job losses or economic instability. Confidence is crucial for economic growth. If people believe the economy is on a shaky ground, their behavior can contribute to a slowdown, creating a self-fulfilling prophecy. Finally, the Fed will have fewer tools at its disposal if rates are already low, limiting their ability to respond to future economic downturns effectively. In case of worse economic conditions, the use of unconventional monetary policy tools, such as QE again, will have diminishing returns and may not provide the necessary stimulus to pull the economy out of a downturn. Thus, maintaining some room for maneuver interest rates is crucial for future economic resilience. In conclusion, the Fed's prolonged use of low interest rates and quantitative easing since 2015 had led to significant economic distortions. While these measures were initially necessary to combat the Great Recession, their extended use has resulted in several problematic outcomes. The continuous injection of liquidity into the market has fueled higher inflation rates. Initially, this was aimed at stimulating spending and investment, but over time, the excessive money supply has driven up prices across the board. This has eroded the purchasing power of consumers, particularly affecting those on fixed incomes or with lower earnings. Low borrowing costs have encouraged speculative investments in various asset markets, including real estate and stocks. The speculative behavior has inflated asset prices to unsustainable levels, creating bubbles that are prone to bursting. When these bubbles burst, they can cause significant financial instability and economic downturns, as witnessed during previous economic crises. Both consumers and businesses have taken advantage of cheap borrowing conditions to accumulate significant debt. While this has driven short-term economic growth, it has also increased financial vulnerabilities. High levels of debt can become burdensome when interest rates eventually rise, or if the economy slows down, leading to potential defaults and financial distress. To move forward, the Fed needs to carefully balance its policies, considering both short-term economic needs and long-term stability. Stability of interest rates and a cautious approach to monetary expansions could help stabilize the economy and prevent future crises. If you found this analysis insightful, don't forget to like, subscribe, and hit the bell icon for more in-depth discussion on economic policies and their impacts. Also, leave a comment below and let's keep the debate rolling. Stay tuned, as some of the consequences and analysis for the future will be further discussed in next videos. See you next week. Bye bye.